A mutual fund is a straightforward idea that can sound more complicated than it really is. Think of it as a large pool of money. Many different people, just like you, contribute their savings into this collective pot. Instead of you figuring out where to put that money, a professional fund manager invests the pooled money across different assets. These assets are typically equity, debt, money market instruments, or a mix of these. Each investor gets units based on how much they invest, and profits or losses are shared proportionally. Simple meaning: many people put money together. An expert manages it. Profits or losses are shared. It's a way to get your foot in the door without being a financial genius. So, why were mutual funds created? Most of us do not have time, do not have expertise, and do not want daily market tracking. Mutual funds solve this by providing professional management through a dedicated fund manager focused full-time on markets. This collective approach lets small investors access expertise and a range of assets hard to get alone. When investments do well, everyone shares in profits. If they perform poorly, everyone shares in losses. First, you decide to invest a certain amount into a specific mutual fund scheme. In return, the fund issues you units. These units represent your ownership slice in the fund's total investment pie. Investor money flows in, units are issued, and the fund manager invests according to the fund's objective. The manager constructs a portfolio of assets like stocks and bonds, aligned to the stated objective. The value of your investment changes every day with market movements. This daily value is captured by a crucial term, net asset value, or NAV. Think of it as the price of one unit. At the end of every business day, the fund totals market values, subtracts liabilities and expenses, then divides by total units to compute NAV. If portfolio values rise, NAV goes up. If they fall, NAV goes down. Your investment's worth equals the number of units you hold multiplied by the current NAV. Mutual funds are not one size fits all. They come in several types to suit different appetites for risk and reward. First is equity mutual funds. They invest mainly in shares and offer higher long-term return potential with higher risk. They are best suited for long-term goals where you can ride out market fluctuations. Second is debt mutual funds. They invest in bonds, treasury bills, and fixed income securities, focusing on stability. Returns are based on interest payments and are generally less volatile than equities, suiting short to medium-term goals or lower risk tolerance. Third is hybrid mutual funds. They invest in both equity and debt, aiming to balance growth and safety. By structure, open-ended funds can be bought and sold anytime. Close-ended funds have fixed maturity and a limited buying period. Interval funds combine both. Choose the structure that fits your liquidity needs and time horizon. One of the primary benefits is long-term wealth creation, particularly through equities that can grow over many years and outpace inflation. Mutual funds help you reach goals like retirement, a child's education, and growing your wealth over time. For steady cash flow, certain funds invest in bonds and high-dividend stocks to pay interest or dividends at regular intervals. Beyond growth and income, some low-risk debt funds prioritize capital protection while targeting modest returns. One of the most important benefits is diversification, spreading money across many investments. Investing is democratized with low minimums, especially via systematic investment plans, SIPs. Putting all your savings into one company is like keeping all eggs in one basket. If it drops, you could lose a lot. A mutual fund buys dozens of companies across sectors, spreading risk. Poor performance by a few is cushioned or cancelled out by the many that do well. A small blip in the bigger picture. Diversification significantly lowers overall risk and provides a safety net for long-term peace of mind. In India, mutual funds have surged on the back of SIPs, digital platforms, and SEBI's strong regulations. NISM exam focus. Mutual funds are not risk-free. Returns are market-linked. NAV is calculated daily. The fund manager plays a pivotal role, and different funds serve different goals.